Are you ready for some more exciting accounting knowledge? I know I am. Let's get started. So what we're going to do right now is really just review what we covered in chapters 1, 2, and 3, which is the relationships among the various financial statements. We start with our balance sheet, which is assets equal liabilities plus equity. And then remember, equity is made up of contributed capital and retained earnings. Contributed capital, which I abbreviate with CC, is made up of common stock and additional paid-in capital. As a review, common stock is the number of shares times par, and additional paid-in capital is any remainder. So if an investor purchased a share for $10 from the company and the par value was $1 would go into the common stock account, and the remainder, $9, would go into additional paid-in capital. That would increase overall equity by $10, and then assets, specifically cash, will go up by 10. The other part of shareholders' equity or stockholders' equity is retained earnings. Retained earnings are the earnings that the business keeps and doesn't give away in the form of dividends. Revenues minus expenses equals net income, so that's our income statement. And the income statement affects retained earnings. That's that arrow I'm constantly drawing from net income into equity. Net income affects equity. How? Well, with our statement of stockholders' equity, remember, it's beginning retained earnings plus net income minus dividends equals ending retained earnings. That's how we determine our ending retained earnings balance. Net income would increase retained earnings, as do credits to the equity accounts. If it were net loss, it would be a negative, which is why the net loss shows up on the debit side, because debits decrease equity accounts, and then dividends also would decrease equity because you're giving money away back to the owners. Those are our three fundamental financial statements: the income statement, statement of shareholders' equity, and the balance sheet, and they're prepared in that order. Income statement first to get net income, which affects the statement of shareholders' equity, and then finally gives us the ending equity balances that would show up on our balance sheet. And then we have to determine whether the balance sheet balances in the end, and if it doesn't, we've made a mistake. Balance sheet accounts are what we call permanent accounts. They carry over from year to year. So the beginning balance in 2020 is the ending balance from 2019 on our balance sheet accounts. Revenue, expense, gain, and loss accounts, those are income statement accounts. Those are what we call temporary accounts. In addition to revenue, expense, gains, and losses, dividends are also temporary accounts. So their balances accumulate over time, but then they're closed out at the end of the period, which we'll cover in the last segment of our Chapter 4 lectures. So they start with a zero balance at the beginning of each period. So we fill up our revenue, expense, gain, loss, and dividend accounts during the year, and then at the end we empty them out into retained earnings, and they start over at zero again. As a reminder of the relationship between the accounts, the income statement gets us net income, which then flows through onto our statement of stockholders' equity because it impacts our retained earnings balance, and then the ending balance from the statement of stockholders' equity shows up in the stockholders' equity section of our balance sheet. Also, cash on our balance sheet would agree with the cash flow statement, which, as I mentioned before, is going to be focused on in a later chapter, the last chapter of the semester. For now, all we need to focus on is the categories of cash flows, which you may remember are operating, investing, and financing. So here's a trial balance for Chipotle. We had our unadjusted balances. This comes from Chapter 2 and 3 work, and then all the various adjustments that we went over in the previous part of the lecture series are all recorded here, which provides us with the ending balances in each of the accounts, known as the adjusted balances. You'll notice that the cash account isn't changed, and the reason for that is that cash is never part of an adjusting entry. So that's something you want to remember, especially on a multiple choice exam or quiz. Any adjusting entry option that has cash in it is wrong. Cash is never part of an adjusting entry because, remember, with deferrals, cash comes before the adjusting entry. With accruals, cash comes after the adjusting entry, which means cash is never affected by the adjustment itself. All of these adjustments are input, and you'll notice the debits equal the credits for the adjustments. Excuse me. And then the adjusted balances are the balances that we're going to use to create our financial statements. Before we do, we want to do a final verification that those balances do agree. That is, debits equal credits. On a trial balance, I don't know if I mentioned this before, but the order is the same order these items would show up on a balance sheet. So we start with assets, which go down to right about here. Then we have our liabilities, starting with account payable, and that goes down to here. Then we have equity. And then revenue on our income statement. And then our expenses. And then our other activities, which are gains, losses, interest income, interest expense, and dividend income. So this would be the non-operating items. In addition, under assets, you'll notice that they're in order of liquidity, cash being the most liquid because it's already cash, and then short-term investments, receivables, and then inventory would go next. In this case, they only have supplies, not inventory, and then all of our other current assets, in this case, prepaid expenses, then long-term. Then for account payable or liabilities, we start with account payable, then our other current liabilities, then our long-term, and then we have equity. The equity account you may not be familiar with is treasury stock. We'll talk about that in a later chapter, but that's when a company buys back its own stock. And then we have revenues and expenses that show up on our operating section, and then the non-operating items like gains, losses, interest income, interest expense, and dividend income, and then income taxes. Preparing the actual statements is relatively easy, and if you think about a multiple choice test or quiz, we're not going to ask you to whip out an income statement or a balance sheet. Instead, we might ask you, given a bunch of different account balances, what net income is. So that means you need to be able to create it. You don't need to focus on how pretty it looks, but you really need to understand that it's revenues minus your expenses. You also need to be able to differentiate between operating expenses and non-operating, which we covered in Chapter 3, and I just reviewed a couple minutes ago. So it starts with the company name at the top. So you see Chipotle's name of the statement, consolidated statements of income. Consolidated means it's going to include Chipotle and any of their subsidiaries. And then an income statement is going to be for a period of time, in this case, the first quarter of the year. Earnings per share is an important number that investors and other users of the financials look to. It tells us how much earnings the company is able to generate for each share owned by the shareholders. So earnings per share is calculated as net income over the average number of shares of common stock that are outstanding. So at this point, for simplicity purposes, you simply take the total net income divided by the number of shares the company has sold, and that gets you the earnings per share. The higher the earnings per share is, the better the company is deemed to be doing, and a lot of analysts predict what the earnings per share of a company would be, and then the stock market reacts to whether the company is able to meet or exceed that expectation or not. Statement of shareholders' equity, you could see under common stock, you got our beginning balance of 1, then we added some additional stock, which gets us to our ending balance of 2. Same with additional paid-in capital. Those are only going to be impacted by issuing additional stock. So when we issue additional stock, both common stock and additional paid-in capital go up. Treasury stock we'll talk about in a later chapter. It's negative because it's the opposite of selling stock. When we sell stock, equity go up. When we buy it back, because it's the opposite of selling it, it goes down. Again, we'll talk more about that later. You don't need to worry about treasury stock for the first exam or any related quizzes that happened prior to exam 1. Retained earnings is that beginning plus net income minus dividends that we've talked about, and that gets us our ending equity, which is going to show up on our balance sheet. And then on our balance sheet, here we have a balance sheet for 2 for the previous year and then the current quarter. You'll notice I skipped over it on the statement of shareholders' equity. The heading also is for a period of time, a quarter, whereas the balance sheet is as of a specific date. In this case, the first quarter and then the previous year. So this shows us the balances of our asset, liability, and equity accounts at that one point in time. The balance sheet is a special statement because it's the only one that's for a point in time. The other statements show us the activity for a period of time. And again, we're working on the first quarter of the year for all of these. So one final thing to remind you about a balance sheet is we break it up into current and long-term for our assets and liabilities. So you could see your current assets in order of liquidity, then your long-term assets, and then the same with your liabilities, current, then long-term. Then you have your equity accounts down here, which for our purposes, we really need to just understand common stock, additional paid-in capital, and retained earnings. Treasury stock we'll hold off for at a later chapter. Why is it included here? Because again, we're showing you a real company. Chipotle is a real company, and these are their real accounts that they have. So just to keep it more realistic and show you that this stuff does matter in the real world and it applies to the real world, some accounts that are a little more advanced than what you're ready for are included. Last thing I want to mention is big data. We're going to be mentioning it throughout the semester. It's really important that you understand that data analytics plays a large role in business now. There's huge amounts of data available, and we need to come up with a way to make that data into useful information. The SEC, which is the Securities and Exchange Commission that oversees publicly traded companies, uses big data to look for trends that may indicate fraud. So that's kind of interesting. We can use statistics and data analytics to look for certain trends in a company's financial statements that may be a red flag for fraud, and then that allows the SEC to determine which companies they need to investigate and look into further, which is going to be done a lot more efficiently than if we needed analysts like humans to go through and try to figure out which companies' financials look suspect, if you think of the thousands upon thousands of companies that are traded on the stock exchange. So data analytics plays a large role in all sorts of different business disciplines. Marketing is a big one, trying to target market your product to people and using data on their purchases and the like to determine which products appeal to which type of people. But even in accounting, we're using big data to make decisions. In this case, figuring out where to expend our time if we're the Securities and Exchange Commission and get the biggest bang for our buck and hopefully uncover some frauds and protect investors at the same time.